Wow, that was quite a start to 2026. We came out of the gates with small caps, value stocks, international stocks all roaring higher. However, once the conflict with Iran started, we saw a sharp reversal and a pretty good sell off in the market. Surprisingly, despite no real resolution to the conflict, we've had a V shaped recovery that's brought the markets back to all time highs. One of the things that fueled that recovery has been very strong earnings. When looking at the S&P first quarter earnings, consensus expectations were for about 15% growth, and we almost doubled that at 28% earnings growth. This also drove more crowding into the AI theme, and the momentum factor has really been on a tear. As we go into the second half, there's quite a few things that we need to be on guard for and maybe sources of volatility. First, it's the Fed. We've got a brand new Fed chair, and markets have an uncanny way of testing new Fed chairs. The Fed's going to have to deal with an elevated level of inflation that's partially fueled by higher oil prices. And so, if those remain high for longer, then we could even see the Fed having to raise rates instead of cut rates. Second, the concentration issue is really going to hinge on the course of AI spending over the remainder of the year and the next year. As it stands now, 2026 spending is probably going to continue to be pretty strong as all of those orders are already booked and on the way. However, as we approach the end of the year, investors are going to turn their focus to the future in 2027, and there will probably be a whole new set of fears around potential bottlenecks in the supply chain. So we think it would be prudent to perhaps diversify a little bit away from this momentum and crowded part of the market and look to add some value and some quality into your portfolio.